Good afternoon, everybody, and welcome to Churchill Tax Advisors' monthly tax dispute, tax investigations webinar. We've got a lot of people registered today, and many people are joining us straight away. There will also be a recording of this webinar, which will be emailed out to everybody who is registered, and it will also be available on our website and YouTube channels. My name is Dave Jennings. I'm Tax Director and Head of Tax Investigations here at Churchill Tax Advisors. We are a specialist firm of tax advisors covering both dispute investigation issues with HMRC, which is mine and my colleague here, Philip Webb's expertise across the firm. We also provide general tax planning, tax advisory for inheritance tax, company reorganisations, wealth tax and asset protections. We provide all those services to clients, accountants, solicitors, and the like. We run these events on a monthly occasion, alternated with our tax advisory colleagues giving a webinar every month as well. So the next one's in 2 weeks' time. I'm joined today by two guest speakers, Philip Webb, who is a colleague of mine here in the tax dispute tax investigations team. Philip is going to talk about VAT and how it's the Cinderella tax of the world, and he'll explain more about that shortly. Our first speaker is Michael Firth from Gray's Inn Tax Chambers, and he's going to give a talk about claims by liquidators and also a bit of knowledge and feedback of recent issues with HMRC that he's had. So without further ado, I will hand this over to Michael, and he can give you his thoughts and expertise. Thank you, Michael.
Thank you very much. Yes, so I'm Michael Firth. I'm a barrister at Gray's Inn Tax Chambers. I deal with advisory and litigation, mainly against HMRC, but really anything that's got a tax angle in it, it may well come across my desk. Today, we're going to look at one aspect of that work, which is becoming a more important aspect, certainly in my experience in the recent years, which is claims by liquidators. And the source of this type of issue is sometimes it's thought that, well, we've got a tax problem, potentially a big tax bill. The easy way out for this company is just to let it go insolvent and it'll disappear. Limited liability, we're all protected. And to be honest, for many years, there wasn't a great deal of activity in this area. If the company went bust, that was generally the end of it for the directors and shareholders. The company had whatever assets it had, and they'd be distributed. But what I've seen and what a lot of people have seen in recent years is that liquidators, often prodded by HMRC, are becoming more interested in looking at what potential claims the company might have against shareholders and former directors. And sometimes it'll be the liquidator themselves pursuing a claim, but more often, in my experience, it's a litigation funder who will have bought the claim or be underwriting the claims on the basis that they'll get a share of the proceeds if and when that happens. And these claims can be pursued quite aggressively because often the person funding the litigation won't get paid anything unless some money is brought in response to the claim. So they can get pretty aggressive, pretty trying for the directors in terms of pushing for some sort of settlement. So that's what we're going to look at today. I'm going to start a slideshow now, and hopefully everyone can see those slides now. Maybe, yeah, Philip's nodding, so that's a good sign. So types of claim. So if you have a client in this situation, or may have a client in this situation, what you'll often get is a letter before claim from the liquidator or the person who the liquidator has sold the claim to, setting out various bases on which your client, who could be a director, could be a shareholder, could have been both, is said to be liable for often very large sums of money back to the company. And it's usually a scattergun approach. They just will throw everything in the kitchen sink at it in the letter before claim just to cover all bases, essentially. But the main areas we see are these types of claim. And we're going to go through each of them and talk about the more important ones in more detail. So the first is recovery of unlawful dividends. The second are alleged breaches of directors' duties. And the ones that are most relevant here tend to be allegations that you distributed an asset without proper provision for a debt. And usually in this context, that'll be a tax debt. Failing to exercise reasonable care, and failing to comply with the duty to consider the interests of creditors. The third type of claim suggested might be a transaction at undervalue type claim, and we'll come to that later, or an unlawful preference of a creditor. And then finally, you've got wrongful or fraudulent trading. So, I mean, there's a big basket of claims that liquidators might be considering against your client, and we need to know how to deal with each of them, and frankly, what the merits of those claims might be, because that ultimately is what you need to know. Is this a good claim? Is my client ultimately going to be found liable by the court for this amount, or actually do we have a defense here? So, starting with unlawful dividends. Now, the basic rules, I'm sure a lot of people are in some way familiar with about declaring dividends. The first rule is that dividends may only be paid out of profits available for the purpose. So if you've got distributable reserves of, say, £100,000, then that's really the maximum you can distribute by way of dividend. An important point, which is sometimes lost on these liquidator claims, is that the distribution in excess of reserves is only unlawful to the extent of the excess. So if you have reserves of 100 and you try to distribute 150, the case law indicates that it's the 50 that would be unlawful based on this rule. You still have a second rule, well, at least a second rule, which is that any dividend must be justified by relevant accounts. And that can be the last annual accounts, that could be interim accounts, or it can be initial accounts. Now, obviously, usually you'll know whether you're dealing with a dividend or not. But the idea or concept of a distribution goes much more broadly than simply a dividend. And essentially, a distribution is any transfer of value out of a company that isn't explained in some other way. So if you pay someone money, if a company pays someone money, if you can say that's employee remuneration, well, that's probably not going to be a distribution. If it's payment for services or for goods, that's probably not going to be a distribution. But if there's no other good explanation for the payment, you're probably looking at a distribution, or something that the courts would class as a distribution. And that can give rise to questions of the boundary. And because you might have a situation where, on the face of it, the company's paying money out to buy goods or services, but actually the services or goods received in return are not worth the same as what's being paid out. And in that sort of situation, the test is to look at the true purpose and substance of the transaction. If it was a genuine arm's length transaction, that simply with the benefit of hindsight has been found to be a bad bargain, it's not going to be a distribution. But equally, if you try to dress up a distribution as an arm's length transaction, then the courts will look through that to the substance. So in terms of practical examples of why this is relevant, well, in the case of re-implement consulting, the court there recharacterized or classified payments to an employee benefit trust as unlawful dividends. So I'm sure we're all aware to some degree about employee benefits trust, and in the sort of more famous cases like the Rangers case, that those trusts were set up to benefit actual employees. It was part of their employee remuneration package when they signed up. But in other cases, where it's essentially the shareholders of a small company, where the directors and the shareholders are often the same people, often what you see is that the payments to the EBT have been calculated essentially to reduce the distributable reserves to nil. So if the company has £100,000 they could have paid out by way of dividend, instead of doing that, and usually with an aim of trying to get a corporation tax deduction, they might pay it to the EBT instead. Well, in that sort of case, which was re-implement consulting, the court looked at the situation and said, well, the amount you're paying to the EBT is essentially your distributable reserves. The people who are beneficiaries of this EBT are the shareholders. albeit they're also directors, and the amounts each shareholder/director was receiving was in proportion to their shares. So looking at the substance of that, that's a distribution. They hadn't gone through the relevant statutory procedures, so the court held that that was an unlawful dividend. The consequence of an unlawful dividend is set out, well, the statutory consequence is set out in Section 847 of the Companies Act 2006, and the primary remedy is that the recipient of the dividend is liable to repay if he or she had reasonable grounds to believe it was unlawful. Reasonable grounds to believe it's unlawful means knowledge of the facts that make it unlawful, not knowledge of the law. So you can't say, well, I knew nothing about Section 847 or the other requirements of the Companies Act for a lawful dividend. Ignorance of the law in this situation is not an excuse. If you knew the basic facts that, as a matter of law, make it unlawful, then you're going to be caught by that provision. There's also the possibility of a constructive trust if the recipient had notice, and that can be important because a constructive trust, to get into some technicality, gives a proprietary remedy to the company rather than a personal remedy. And that can be important if your director or shareholders themselves potentially looking at bankruptcy or potentially has debts in excess of their assets. It means that notwithstanding the situation of other creditors of that person, the company will have essentially a priority to go in and trace where that money from the company has gone and lay its hands on the proceeds. So that's quite an important point. If it arises, there might be a constructive trust. But equally, in assessing whether this liability arises, the courts have held that the directors are entitled to rely on the opinion of others, in particular auditors, as to the accuracy of statements in the accounts. So it's not an entirely strict liability based on the existing case law. There is a step in there that has to be looked at, which is the reasonableness, or whether you had reasonable grounds to believe. We'll come later to the question of the accounts and auditors, because an often important issue in these sorts of cases is whether a provision should have been made in the accounts for a suggested tax liability. And what you often see in these sorts of cases, in particular the EBT type case, is the liquidator or the person who's bought the claim saying, well, you should have made a provision for the possible liabilities to employment tax, PAYE, NICs, and probably corporation tax in your accounts. And if you'd done that before making these payments to the EBT, your company would have been insolvent, and therefore you wouldn't have been allowed to make this distribution, and therefore it's unlawful. So it's very important, or a very important part of these cases often, to look at what provisions should have been made in the accounts. And we'll come later to see what the law says about those issues. So that's the first type of claim, which is unlawful dividend. The second type of claim is breach of director's duty, and this is often a very important branch of claims, because it's not hard to throw allegations of lack of reasonable care at directors in a situation where a company's become insolvent. Usually, it's very easy to make that sort of allegation. More difficult to disprove it. So it's a very common basis of claim. The types of duty that are invoked are usually wide-ranging, but the most important ones, the ones that are probably going to decide the case at the end of the day, are the duty to exercise reasonable care and potentially the duty to consider the interests of creditors. The duty to exercise reasonable care does what it says on the tin. It's essentially a reasonable care / carelessness / negligence type test, and we'll look at that in a bit more detail in a moment. The duty to consider the interests of creditors is a duty that only arises if the company is or is likely to become insolvent. But when it does arise, so if the directors are in a situation where the company is likely to become insolvent, then the courts have held that the creditors' interests are probably paramount. In terms of complying with that duty, well, the duty is to consider the interests of the creditors, and the case law suggests that if you do consider the interests of creditors and act appropriately on that basis, then you've discharged that duty. By way of example, this duty was held to have been breached where an otherwise lawful dividend was paid out, but it left the company unable to pay its debts when due. That was held to have breached the duty. Importantly, in some cases, de facto directors can be liable for breaches of these duties. That's what the Supreme Court held in HMRC in Holland. And that can be important because you sometimes have companies, possibly a Phoenix company, where certain people have avoided becoming properly appointed directors, but are in fact acting as if they were directors of the company. And in those circumstances, you can't escape liability for breach of director's duty simply because you weren't, as a matter of law, appointed. So it can be quite a broad range of people who could be caught with this in particular circumstances. And the most common remedy, subject to defenses, which we'll come to, is that the director is obliged to restore money that's wrongfully paid out. And that's usually the sort of remedy that the liquidators or the person pursuing the claim is seeking. They will often identify payments to EBTs or dividends that they say were wrongfully paid out and demand that you pay them back in full. And they often go for obviously the highest amount possible. So even if the company was solvent and say had reserves of £100,000, but paid out £200,000 to the EBT, that the liquidator will often claim the full 200, even though 100 could have been paid out entirely lawfully by way of dividend. And that can be important, as we'll see later when we come to the question of defenses and the discretion as to remedy, because in my view, the most likely remedy in that sort of situation should be a liability to pay the 100 rather than to pay the 200. So this, as I mentioned before, is quite an important point in tax cases, because often there's an allegation, particularly if you participate in a tax avoidance scheme and subsequently gone insolvent, that anything you paid out by way of distribution, including dividends, once the scheme had been entered into, was unlawfully paid out because the directors hadn't made proper provision for debts, in particular tax debts. And so what the liquidator will argue is that, well, you've done this tax scheme, but you must have known there was a risk it wasn't going to work. And if it didn't work, you'd have the corporation tax liability and the PAYE liability. You didn't make any provision for those possible liabilities. You should have done. And therefore, the amounts were paid out in breach of your duty to exercise reasonable care and make provision for debts. Well, what does the law say? And this is quite important. The law says that that a provision is required to be made if the tax liability is more likely than not to exist or arise. So what you often see is the liquidators simply assert, well, you could have foreseen a potential tax debt here. You were doing a tax scheme, so you must have been able to foresee a potential tax debt. If the scheme didn't work, you didn't make a provision for it, therefore you're liable. The law is more nuanced than that. The law says that actually you only have to make a provision if the tax liability is more likely than not to exist. And in judging that, it's not unlawful if you can only reach that judgment with the benefit of hindsight. So it's no good sitting there 3, 4, 5 years after the event and saying, well, now we know that this scheme didn't work. Look at what the court said in that case. That's not good enough. No, what needs to be looked at is what the directors knew or should have known at the time the provision is said that it should have been made. And what they're required to do is come to a reasonable judgment based on the facts as they would have been ascertained after reasonable inquiry. So if the directors have taken proper advice on tax scheme, and that advice was to the effect that, well, we think that this tax scheme works or is likely to work, then you'd have a pretty good argument for saying no provision should have been made. In all cases, or nearly all cases, you're going to get some level of risk warning and an advice on a tax point. So the fact that you're aware of some risk that tax liability might arise doesn't mean you're required to put a provision in place. In contrast, however, the court held in Re Loquitur that tax scheme was flawed on any reasonable view, and therefore a provision was required. So you can see how how this ultimately comes down to a question of judgment, and it's often not as clear-cut as the liquidators would have you believe based on their letters before claim or indeed their pleadings. What needs to be debated and argued is, well, was it reasonable to not make a provision? Was it more likely than not that a tax liability did exist based on the facts and circumstances as they could have been ascertained at the time? And often, when people have entered into these tax schemes, they have done so on the basis of professional advice. And so you've got a pretty strong basis for pushing back on that and saying, well, no, we don't think a provision should have been made because we act on the basis of this advice. This advice says the tax scheme probably works and therefore no provision. So although that's quite an important ground of claim for the liquidator, often you'll find that there's strong grounds for pushing back. Another principle to bear in mind in these sorts of cases is what's called the Duomatic Principle, which essentially says that if something has happened in relation to a company and it could have been approved by the shareholders, if it essentially was approved by the shareholders because they were aware of it, turned their mind to it at the time, then notwithstanding that it might amount to a technical breach of company law, the ratification principle comes in and it's treated as not being a breach or not an actionable breach. Because you've got to bear in mind that what the liquidators are doing in these cases is bringing the company's claims. These are not the liquidators' claims, although I call the presentation that. Actually, these claims belong to the company. It just so happens that after insolvency, the liquidator takes over and is the person that sort of acts on behalf of the company. So in the period before the liquidator takes over, the shareholders can ratify potential breaches of company law, subject to limitations, which too detailed to go into here, but in principle they can ratify breaches of company law. And if that's the case, then the company won't have a claim against the shareholders or directors, and the liquidator won't have a claim. So it can be quite important, subject to 2 points, which I set out here. First, the principle could only apply if the shareholders actually turn their mind to the question of the transaction. And in the case I've cited there, Ball and Hughes, the court found that the shareholders had never turned their mind to the question. The court said, on the evidence before me, I'm not persuaded the respondents ever applied their minds to the question of whether to ratify credits 1, 2, and 3 as remuneration. Quite to the contrary, their efforts were focused on extracting the monies by other means. So that can present something of a problem if they've entered into a tax scheme to try and take money out of the company otherwise than by employee remuneration, to later try and argue that the company has ratified directors' remuneration in those amounts can be quite difficult because you were trying to do something else. And that's essentially what the court is saying there. The second and probably more important limitation is that it doesn't apply if the company is insolvent or likely to become insolvent as a result of the impugned transaction. But the limit on that is you've got to apply the principle at the stage of each transaction. And often when you look at these sorts of cases, particularly EBTs, you've got contributions to the EBT over a period of time. And it may well be that some of the earlier contributions could fall within the ratification principle, even if ones at the end don't, because by that point the company would be insolvent or likely to become insolvent if that particular transaction was impugned. But you do have to look at it on a transaction by transaction basis. And this is important. This is one of the points that the liquidators often overlook in their letter before claim because it's not for them to raise. But equally, it's sometimes in the cases you look at them and you think, well, why didn't they raise the potential defense of the court's discretion to to excuse a breach in whole or part, and that can explain some cases which appear to be in favor of the liquidator, but actually you think, well, why didn't they raise this point? Maybe they just didn't think of it. But it is important because the court has the power to relieve a director of any liability arising under the principles I'm talking about, in whole or part, if the court concludes that they acted honestly and reasonably. And you may be thinking, well, isn't the breach of duty the fact that they failed to exercise reasonable care? So how are we going to be able to rely on that? in response, the High Court has held that conduct may be reasonable for these purposes, even if it amounted to a lack of reasonable care. So that's something of a conceptual conundrum. You behave reasonably, but not with reasonable care. But that is where the law ends up at the moment. And it makes a lot of sense, because necessarily, if you've breached the duty of reasonable care, then you haven't fulfilled that reasonable care standard. And this provision must be intended to have some effect in that type of situation. So reasonableness in this situation does impose a lower standard. And the sorts of factors that are relevant are the same sort of factors you would say were relevant to reasonable care. So, as I've set out there, reliance on a professional advice may render conduct reasonable. So there might be situations logically where, where the conduct was not to the reasonable care standard, but nevertheless satisfied this honestly and reasonably standard. The second point is that relief can be available even if the consequences render the company insolvent. So even in those situations that I was talking about a moment ago, where, for example, you've got contributions to an EBT, and the effect is to render the company insolvent, it's possible, although certainly less likely that the court may order relief in that sort of situation. And it's particularly relevant to consider what distribution could have been made lawfully. And I think this is often one of the most important points, because in those situations where you do have directors who be, for example, paying money that could have been used to pay a dividend to an EBT instead, because they've been told that's going to get them a corporation tax deduction and avoid tax. And then the liquidator comes along and argues, well, if you'd made provision for this, the corporation tax debt, let's say, you wouldn't have been able to pay the full 100, you would have been able to pay 50. Therefore, the whole thing is unlawful. You must pay us the full 100. Well, actually, I think that's wrong, or at least very likely to be wrong when you look at the discretion of the court, because the court's going to look at that and say, well, yes, you paid 100, but you could have paid 50 on any view. So we're going to limit what you have to pay back, so the excess, to just the extra 50. Which can have a very significant impact on these claims, because often what is happening in those situations is amounts that could have been paid by way of dividend are diverted, for example, to an EBT. And then you would be arguing against the liquidator that, fine, maybe you do have a point that this was an unlawful distribution. See the earlier slides on that. But even if you're right about that, we think the maximum amount you're going to get from the court is, say, 20% of what you're claiming, because the rest of it could have been lawfully paid away, and we think the court will give us exercise its discretion in this respect. And by way of example, relief was granted when relying on professional advice regarding tax until leading counsel advised that the scheme didn't work in HMRC in Holland, but it was not granted in Reloquitur, where the court held that there was no genuine belief that the tax scheme would work. I mean, that's quite a serious finding. So you'd expect that to be relatively rare if people have taken proper and professional advice, but that sort of illustrates two ends of the spectrum here. So that's the breach of director's duty. You'll also often see that other claims related to these sorts of issues are raised, like transaction at undervalue and unlawful preference. There are two main kinds of transaction at undervalue claim. The first applies to transactions at undervalue within 2 years of onset of insolvency. And that's quite a broad test that catches pretty much anything that amounts to a transaction at undervalue within 2 years prior to insolvency. But you can see there is a defense for a good faith transaction intended to benefit the company. But the court and the liquidator can ask the court to go back even further if there's a transaction at undervalue that was for the purpose of prejudicing creditors. And this is part of the general rule that sets aside or can set aside a transaction that's aim is to defeat potential creditors of the person carrying out the transaction. And in that case, then they're not limited by the 2 years. Whether the transaction was intended to prejudice creditors is a primarily subjective question. It needn't be the primary or main purpose of the transaction, as long as it was a purpose rather than a mere consequence. In terms of the sort of transactions that can be caught by this, well, the courts have held now that dividends can potentially fall within this transaction at undervalue rule. So you can see how you might end up with 3 claims essentially based on the same allegation. Around, you've got unlawful dividends, you've got breach of director's duty for failure to make a provision, and you've got potentially transaction at undervalue. So that's why you can have quite heavy fire coming at you and your client in that sort of situation. But what the courts have also held is that employee remuneration packages are not generally transactional at undervalue. And that makes sense because the employee is giving something in return. They're giving their time and effort. So that's usually not a transaction at undervalue. And you've also got sitting alongside those claims unlawful preference of creditors. I mean, that'll cover situations, for example, if the company is about to go bust and you decide to pay off loans to shareholders just before you go into insolvency, well, then you're probably looking at an unlawful preference claim, which will set aside that transaction. Oops. And in terms of remedies, again, the normal order would be to restore the position to what it would have been but for the transaction at undervalue. But there is a discretion to limit the award. That's what the court held in HMRC in Holland. You can't award no remedy, but the discretion was exercised to limit the repayment to the amount of the provision that should have been made in HMRC Holland and Relocator. And that takes me back to the point I was making a few moments ago, which is that even in cases where it seems like the liquidator has a slam dunk case on breach of duty or unlawful dividend, there's often a lot to argue about in terms of, well, what remedy would you get? Would you get the full remedy you say you would, i.e. full restoration of the position? Or actually, do we have a pretty good argument that you get something less than that because we had reserves that could have been paid out and it wouldn't be fair to give a remedy over and above that? And that can be important because the liquidator is not, on the face of it, trying to just recover the tax debt. The liquidator is trying to recover as much money as they can. Part of it will probably go to pay the tax debt, but they've also got to pay their own fees. And if they've sold the claim, then there's going to be some sort of probably profit sharing arrangement there. So they are not concerned simply to make HMRC whole. They're concerned to try and get as much money back into the company as they possibly can to pay all the debts of the company and probably their own expenses. So limiting it to the amount of a tax provision that should have been made is often quite a very useful limitation. And speaking of limitation, in all these cases, you've got to consider limitation periods, whether the liquidators have started or will start their claim within the relevant statutory time limits. But that's quite a detailed set of rules that we don't have time for today. And I think finally, just to touch on wrongful and fraudulent trading, because again, these can be thrown in the basket. They're often not the primary claim, but they're often there as an additional threat. So fraudulent trading is where the company business is carried on with intent to defraud creditors or any fraudulent purpose. That's very rare to see in practice, and often the more usual basis of claim is wrongful trading, which is essentially continuing business when the director ought to have known that there was no reasonable prospect that the company would avoid going insolvent. Essentially, the directors have a duty, if and when they realize this is going to end badly, we're going to end up insolvent. Frankly, that's when they have to call in the liquidators. They can't try and trade their way out of it. And if they do try and trade their way out of it, then they're going to be liable for the additional harm caused by that further trading. So you sometimes see that alongside, but it's often a less important claim. And yeah, simply see further. That's a website that I update when I get the time that has a lot of that information set out on it if anyone's interested in seeing a little bit more. But that's what I wanted to say.
Excellent. Thank you very much, Michael. There's some extremely useful information there for advisors, and I think is used to be aware of as well when companies maybe are facing insolvency beforehand, and take professional advice from the relevant people before you do that. I think it's better to be preventative than to try and react afterwards. I think is one usual moral when it comes to business and tax as well. But obviously it's crucial for directors who could be facing very serious penalties if things go go pear-shaped with insolvency. It's not as simple as thinking, well, there's some debts here, particularly the revenues. Let's wind the company up and escape these debts from HMRC. It's not as simple as that at all. And the revenue are being way tougher than they used to be. Rules are changing. We've now got joint and several liabilities as well, especially with tax schemes and avoidance. And we've covered some of these points in previous seminars. So always take professional advice if you need anything. Do you want to check on the questions there, Michael, if there's any that you're able to answer?
Can I just ask a question to Michael?
Yeah.
You mentioned about the litigation funders coming in and obviously funding these claims. How does that sit with creditors and the duty to maximize return for creditors? Because I'm guessing litigation funders are not doing this out of the goodness of their heart, and that there's a sizable percentage of recovery that they would be entitled to.
Absolutely. A typical structure would be that the litigation funder might buy the claim for a small upfront fee and then agree to some sort of split of the ultimate proceeds. The advantage to the company and liquidator is that the funder will then fund it. So if the company has no money and the liquidator doesn't want to incur the risks of pursuing what could be quite expensive litigation, the benefit to the creditors is that instead of nothing happening with that claim, it is pursued and they get a share of the profits. So it's a judgment for the liquidators, really, whether they believe that this claim is something that they should pursue themselves and they can afford to and have the resources to pursue themselves, or whether actually it would be simpler and therefore in the interest of the creditors overall, simply to sell it to a litigation funder and wait and see what happens. And these days, it's becoming much more common to see them sell it. And you've got litigation funders who are quite active in this market and sort of have good relationships with a lot of liquidators, so that there's a sort of a more of a conveyor belt approach to getting the claim from the liquidator to the litigation funder. And certainly that's becoming a lot more common.
So does that mean that, as we're talking a lot about tax debt here, that HMRC are happy for these debts to be sold, and as POP's usually the largest creditor, to sit back and see how the litigation fund claim works out?
Yeah, well, the tax debt itself is not sold because that's a liability owed to HMRC. What is sold is the claim against the directors. And I've not spoken to HMRC about it, but you infer from the situation and the way it's dealt with that, yes, HMRC are quite happy for someone else to undertake the risk of funding this litigation in return for them getting a share, because HMRC haven't got the time or resources to be pursuing this. The liquidator, logically, in these situations, doesn't have the time or resources. So the person that does with these litigation funders, they'll carefully look through the claim. And what they'll also do in advance is they'll look at your director shareholders, the person who the claim is going to be against, to make sure that, in their view, that they've got assets. So they'll be looking at land registry to see what houses you've got, anything they can do to sort of investigate your client, your shareholder or director, to see if they're a person with money at the end of the day. They'll be doing that to form a relatively full picture of what the outcome of this claim is. And then the strategy is really to settle, in my experience, because yes, they could go to court, and sometimes they do go to court, and we've seen some of the cases there, but it's much more efficient for a litigation funder to throw the kitchen sink at it at the beginning, scare your client, worry them with huge amounts, sort of millions, and then go to a mediation and say, well, all right, we'll accept a couple $100,000. And the client thinks, wow, escape lightly there, but it's that's the business model, and well, it serves a purpose in terms of if the company has legitimate claims and they are realized. That's simply how the law works, as we know.
Yeah, excellent. So was there any questions you can briefly cover at all, Michael? If not, obviously we can move into Philip with the VAT.
Just 1 second.
If people have questions, or obviously questions from Philip as well, you can just type them into the comment box at the bottom right of your screen.
Yeah, I don't think there's any questions specifically on the points I've been covering. So I mean, there is questions on slightly related matters, but I'm not going to it would be going off in a tangent to deal with them now, so perhaps they can be dealt with later.
Yeah, fine. Obviously, if people have got questions that can't be answered today, please do drop us an email, and we'll see if we can answer those. If I can now turn to Philip now, if you can introduce yourself, Philip, and your talk about VAT and how it's sometimes perceived as being a bit of a Cinderella tax.
Yes, I've been with Churchill Tax since April 2019. Before that, I worked for various bespoke litigation firms dealing with taxation, and in 2007 I left HMRC. I was working in the solicitor's office as an advocate and had previously been a tax investigator, with the emphasis being on VAT. My background was VAT. I started in HMRC in 1990 as a baby VAT officer. And since then, it has always, one of the reasons, somebody said to me, why have you called this the Cinderella tax? Is it because it's Christmas and it's pantomime season? And the short answer to that is no, it's nothing to do with pantomimes. But it's Cinderella tax in as much as Cinderella used to be ignored by everybody until obviously things changed for her. And that's one of the things, is that VAT can at times be the ignored tax. Everybody tends to focus on self-assessment, quite rightly. They will focus on capital gains tax, corporation tax, and VAT tends to come at the bottom, I think, of everybody's awareness of the taxes that HMRC are responsible for. And I just wanted to remind people that although it is a simple tax, it is a charge on your sales, and that you can recover the VAT that you pay out on your supplies. It is a little more complicated than that. We must remember that there are more than one rate of tax. Currently, the main rate is 20%, but for instance, if you're involved in the hospitality industry, you're only paying 5% VAT on your sales as part of the government's assistance to that industry because of COVID. And I think that's something that's going to be reviewed in March 2020. There's also the zero rate. The zero rate, of course, applies to the supplies of food, children's clothing, printed matter, etc. And by and large, most people can get those elements right. But people do get themselves into trouble. We must remember that, first of all, VAT is a tax that is collected in the main quarterly throughout the year, that you're required to charge the VAT when you make sales, that you collect the VAT when you make sales, and that when your time comes to put the return in, you declare the VAT to HMRC, less any VAT that you're recovering on stock where you've been charged it, purchase of assets, for instance. So in the main, people pay VAT. There are, of course, some VAT registered businesses that may be exporting purely to Europe, where they're buying goods from the UK, and in which case they would be permanent repayment traders. Now, the rules, and I'm not going to go into the rules today, but I should emphasize that people should be very carefully reading and using government websites about any changes to VAT rules with the end of our transition period following Brexit. It is likely that there may be some changes, there may be some reporting changes with regard to VAT, and it is very important that you can, that you know and bring yourselves up to date if you are trading with the EU. I should also mention, I've mentioned standard rated supplies, normally at 20%, certainly for things like accountancy fees or legal fees. There's also the zero rating, and there's also exemption. An exemption may be that if you're dealing in financial matters or property matters where VAT does not apply, then these will be exempt services. Again, it's very important that you understand your VAT rates, your VAT rates for your business. Very important that you get your returns in on time. One of the key things about this is that it can be that there is a penalty regime for late returns and for late payment of the amounts of money on the returns. These amounts go up to a maximum of 15% of the tax that is due. Now, that can be a lot of money if you're paying £50,000 a quarter to VAT. So it is absolutely imperative that you get yourself, get everything organized, work with the teams, either the compliance teams of accountants or your own internal bookkeeping teams, that returns are put in on time. At the moment, we are going through unprecedented times and people are struggling. Cash flow is a problem. If you feel that you're not going to be able to pay all of the tax at the time that you should, one of the key pieces of advice I would give you is pay what you can when you should, and contact HMRC straight away to explain the situation to them and to get agreements in place to pay the rest of the money. It is absolutely vital that you stay in touch with HMRC if you're having any difficulties. And again, especially at this time when people are struggling. I don't want to go in. VAT is a vast subject. We do have, when we operate under the V80 Act 1994, excuse me. My apologies, that was my phone. It was HMRC calling. But it is vital that in these times of people struggling with COVID, with the uncertainties around Brexit and what is happening, that if you are struggling or if you don't understand something, that you contact HMRC and you get on record the problems or whatever it is that you're having. There is, as I say, the VAT Act 1994. There may be a new VAT Act that reflects us leaving the European Union. That may come next year, it may come the year after, but it is certainly something that will be happening in the future, I would imagine. That's all I've really got to say as a brief introduction to this matter. If you have any VAT queries, please contact Churchill Tax on the numbers that go on our website, and then somebody will be able to respond to you. But don't let problems with VAT fester, because if you do, sometimes they can become much bigger problems than any of the other bigger taxes, and Cinderella goes from being the Cinderella tax to being a very, very ugly sister. Anyway, that's all I'd like to say for the moment.
Thank you, Philip. It's a useful reminder for everybody, and I can certainly echo the point about compliance being important and keeping the revenue informed if things do go awry. The revenue do keep a risk register, and if, say, in the future you need help from the revenue for a time to pay arrangement, if you've got a bad compliance history, they're going to be less sympathetic. So the better you can keep the revenue happy as you go along, the more chance you've got of receiving a sympathetic ear when you need them to pay favours back if you need to enter into arrangements. And talking of which, Philip, we've got a question that's come in this afternoon from somebody saying that they're due a repayment from HMRC, but they owe them for some past VAT. Will the revenue, will HMRC, will they repay them in that circumstance?
No, they will. The repayment, if say you owe them 20,000 and your repayment is 15,000, then they will withhold all of the £15,000 and offset it against the money that you owe. If say you owe them 5,000 and your repayment is 10,000, then they will withhold 5,000 and you will only get 5,000 of your repayment. It's something you should be aware of because, of course, in the situation where people are owed or expect to recover or reclaim VAT, they make cash flow provisions based on that. And it's something that, because HMRC just automatically withhold the money, can completely throw cash flow planning completely out of sync. So it is something that you should be aware of, and they will do it even if you have time to pay agreements in place, which seems to me and to people that I've encountered this as clients is extremely unfair. But of course, they do make the provision in the time to pay agreements that current liabilities must be held up to date. And from their point of view, if the current liability is a repayment and you've got money owing, then they're entitled to take it.
Okay, thank you, Philip. Yes, it's again, it can be a very difficult situation, but there is maybe ways to negotiate with the revenue around that. Another question that's come in, and I suppose it's sort of linked to some items that we'd put on the website recently as well, and an issue I'm aware of. The revenue have loads and loads of information from the likes of Just Eat and other takeaway platforms, and certainly if takeaway businesses have not been declaring income from Just Eat, for instance, then HMRC are likely to open an investigation into that side of the affairs, because they do have the information from Just Eat, just in the same way they have information from eBay and Amazon Marketplace and other third parties. They hold all that information and check against tax returns. But the question that's come in, Philip, is that somebody runs a takeaway, or their client runs a takeaway, and they've not been keeping proper records in the past. It's been keeping them awake at night, which I'm no doubt it has been doing, apart from doing late night takeaways. What should they do in that situation, Philip?
Well, I think first of all, you've got to get professional advice, and then you've got to be in the position perhaps to get ahead of the game and make a voluntary disclosure. You mentioned the Just Eat and the other third parties that provide information. So Just Eat, Deliveroo, and I think there's Uber Eats now, is to first of all go to them, get the information that they hold if you use them. I think there are still some takeaways that don't use those third parties, but in whichever case, you've got to, if you've not been keeping a record, you've got to start for a record now. And what I would suggest is that you keep a daily record of your takings. If you do standard rated and zero rated, if you provide cold food, keep a record of that split. And then by you going to get professional advice, either from a firm like ourselves or your accountants, you can go to HMRC and say, look, we haven't kept this idea. We can't use the bank statements because a lot of money was received in cash. So what we've done is we've looked at what we've been doing over the past month, and then we've extrapolated back. It is a sensible approach, and if it's keeping you up at night, then it really is a case of getting professional advice and trying to get ahead of the game. And it will matter, because when HMRC decide how much you owe, it may be that they don't charge you the full penalties because you have made a voluntary approach to them to resolve the situation.
Thank you, Philip. One final question, briefly before we finish, and again, I guess this might be something that will crop up in the future with the way that the high streets are being decimated potentially with COVID and the lack of trade. So somebody says they bought a property and they've been charged VAT. They want to convert it into residential flats, and we may well see a number of high street shops and premises and the like maybe being change of use into residential flats. Can they deal with that and the VAT consequence?
Well, basically, if you buy a property that is opted, then it's a commercial property. If you want to change its use, you're more than able to do so, but HMRC will object and will refuse the full recovery. So if you buy a shop or a commercial premises that's got 2 stories, but you're going to change 1 story, if you can get planning permission, to residential, then there would be a calculation and a percentage based, and HMRC would say, well, we're not going to give you the full recovery. We will only let you recover the amount that will continue to be used as commercial property. This is something that, going back to basics, one thing I have to stress: if you're entering into a property deal, a commercial property deal, is to check the contract very carefully so that it's understood what is being sold and that there may be an option to tax. Not all commercial property has an option to tax. It is something that you can choose to do. It's normally done to assist with recovery, but it may be that you buy somewhere and you're only going to be making, say it's somebody buys a commercial property and they're going to operate as an independent financial advisor, so they only make exempt supplies. That would mean that they would be having to pay VAT on rent or charge VAT on any other rent, but they wouldn't be able to recover it because the supplies that they make are exempt. It's very important that in these transactions, 1, proper due diligence is done, and 2, that proper advice is sought before transactions are completed.
Right, that's excellent, succinct advice, Philip. Thank you very much. So without further ado, thank you very much for watching our presentation today. For those who've attended and for those who are watching the recording, thank you for doing that. We've had some expert advice today from Philip on VAT and Michael, our guest speaker, around claims made by liquidators. Thank you very much, Michael. We will see everybody in a month's time for in the new year. Our tax advisory team have a further webinar in a couple of weeks. Otherwise, we'll wish everybody an excellent festive period and stay safe, and we'll see everybody in the new year. Thank you very much.
Thank you.
Goodbye.